Time for the market report. Looks like dramatic changes by the day.
That's right, Mike. A commodity will rise one day, then bottom out the next. Things are moving fast in the markets. Difficult to make sense of it, and we'll dig into the potential reasons. But first, the numbers. What were the week's biggest gains and losses? And then several USDA reports giving us an idea of how cattle, sheep, pigs, and chickens stack up inventory-wise from a year ago. And finally, in our road report with tariff talk, price fluctuations, and other factors, what do the professionals have to say? So, markets closed the week still on a downturn. Most commodities down, but some turned around. Let's take a look. The week's biggest gain, lumber again up $30.50. That's almost a 6% increase from the previous week. Lumber's been rallying a good bit lately. The week's biggest loss, soybean oil, down nearly 1/4 cent. That's a decrease of more than 1.5 from the previous week. So, livestock prices still in the green for now, and several USDA reports could give us a reason why. In short, they compare U.S. and Canadian livestocks, giving us insight into how things stack up compared to last year.
In the United States and Canadian cattle and sheep report, U.S. cattle inventory down 1%. We've heard that before. However, Canadian cattle inventory also down 1%. Both countries combined amount to about 97.5 million head. Last year it was about 98 million head. So how does that break down? The U.S. contributes the majority at about 88 million head, while Canada has about 11 million head. Sheep is a slightly different story. The U.S.-Canadian combined inventory up slightly. Last year it was 5.85 million head. Now it's 5.86 million head. That breaks down to the U.S. contributing 5.05 million head, while Canada has actually lost inventory, contributing about 806,000 head, down 2% from last year. The United States and Canadian hogs report looks similar to the sheep report. All hogs and pigs from the two countries about 90 million head, which is up 1% from last year. However, breeding inventory is down slightly. How does that add up? The U.S. inventory about 76 million head, up 1% from last year, while Canada about 14 million head, down 1%. In the U.S. broiler hatchery report, we're seeing some comeback for the industry. Broiler chicken eggs set in incubators, that is, being hatched to add to the national flock, up 3% from last year, and average hatchability is about 79%. In addition, broiler-type chicks placed in brooders to help them grow amounted to about 191 million, up 2% from last year.
In our row report, a lot unfolding within the markets these past few weeks, and more to come with ongoing trade discussions. Analyst Shawn Hackett says, don't base your trades on headlines, and talks about what's moving row crops.
I really don't believe reacting to these headline risks are the way to market your grain crop. We believe, if you look at the first President Trump's presidency, we had a lot of these back and forth headline risk actions. And what you want to do is be proactive when they get excited about what he says, and get excited when to the downside if you're a livestock producer needing to buy corn. We just had some very good cash selling opportunities a month ago. Now we're getting some good buy side opportunities for the end user. I would use the headline risk as being proactive instead of the other way around. Fear is everywhere right now. But also remember, fear gets priced into the markets very quickly, and then we move on to something else. When I look at the calendar, I see the planting season right in front of us. So what we're talking about with tariffs is demand side fears. What we need to be also balancing that with is supply side fears as we move into the planting season and into the growing season. We think that's going to take center stage here before too long. What I think moves the dial on price is the planting season. We think we could have a very cold, wintry spring, something I know everyone does not want to hear, and we could be looking at a late spring frost. All our indicators say that we have some of the best probabilities for that happening this planting season in a very, very long time. This time of the year, with Brazil harvesting their crop, they always buy less from us this time of the year because Brazil has all kinds of soybeans to sell. So this would be a time that they wouldn't be necessarily buying a lot from us. I would not expect them to be buying a lot from us, not because of tariffs, just because the nature of the beast. Brazil has the supply, and that's going to be your lowest, most economical price right now to buy. I think what could drive the soybean market is a bullish planting intentions report we might get at the end of March, where we could be looking at less intention to plant soybeans versus corn. That could be a trigger that maybe brings some short covering into the market and an opportunity to see a higher price. The economy is very, very important. We have a lot of fear over the U.S. economy and the global economy going into recession. The GDP now from the Atlanta Fed showed a minus 1.5 number potentially for the first quarter here. And then you throw the tariffs on there and lack of Chinese demand, and it's just struggling looking for demand. Having said that, we are expected to plant the lowest amount of cotton acres in the U.S. in 10 years. Any weather issues in western Texas that increases abandonment of that crop, and the supply side could take hold here. And if we have any interest or any change in the demand side picture at all to the positive, we could have a mismatch.
And that's it for a deeper look into the markets. Prices rising and falling quickly. Looks like that may continue for some time.